Miami headlines boast record property prices and surging international buyers. But behind the glossy averages, South Florida's real estate strength is collapsing, with luxury condos slashing prices up to 18%, inventories quietly exploding, and insurance costs spiking by tens of thousands of dollars. Why does official data hide the crisis? And where are the warning signs nobody wants to discuss? Here is what the numbers really reveal, and what everyone stands to lose next. On paper, South Florida's housing market still looks unstoppable. Miami, Fort Lauderdale, Boca Raton, and Palm Beach continue to post headline-grabbing prices. As of late 2025, the median price for a single-family home in Miami stands at $410,000, barely changed from a year earlier. Local news outlets point to this stability as proof of foreign capital flowing in to high-end condos and waterfront estates. Job numbers seem to reinforce the story. The Miami, Fort Lauderdale, and West Palm Beach metropolitan area reports unemployment at just 3.7%, among the lowest rates for any major city in the country. CBS Miami called the labor market remarkably tight, and real estate columns highlighted full employment as the last true bright spot. Realtor.com's latest analysis credited this low jobless rate with keeping buyer activity surprisingly strong, even as uncertainty grows in other parts of the country. In the press, the message was clear. Jobs are plentiful, buyers are still coming, and prices are holding firm. But these headlines rely on broad averages and lagging indicators. The high median sales figures, the steady drumbeat of international demand, and the below 4% unemployment rate all paint a picture of health that feels convincing until you look closer. Underneath the surface, the lived reality for many owners and would-be buyers is starting to diverge sharply from the official story. The numbers celebrated in the press reflect deals inked months ago, not the mounting pressures quietly building in key segments of the market. While the city-level data shines, hairline cracks are spreading across the foundation. The true state of South Florida real estate is far less certain than the headlines would have you believe. Zillow's citywide price charts still show Miami and Palm Beach posting year-over-year gains. But beneath those reassuring averages, Redfin's dashboards tell a different story. In Sunny Isles Beach, zip code 33160, active inventory has jumped 22% in just 12 months. Pending sales are down sharply, and luxury towers that once moved units in days now see listings linger for 2 or 3 months. The average days on market for high-rise condos has stretched from 44 to over 90, with some waterfront units sitting unsold since spring. Price cuts are no longer the exception. In the top luxury segment, $2 million and up, 12% to 18% of all listings have dropped their asking price at least once since August. Sellers who once refused to negotiate are quietly offering 6-figure concessions. Redfin's price cut dashboard for Sunny Isles and Brickell now flashes with double-digit percentages, while the citywide median on Zillow barely budges. This split is not just academic. It is the difference between a market that looks stable and one that is fragmenting beneath the surface. Average prices can stay flat, while key segments, older condos, investor-heavy towers, and pre-construction luxury start to break away. The result is a widening gap between headline numbers and what buyers, sellers, and owners actually face. In practice, this means that a waterfront condo in a building built before 2000 may sit unsold for months, even as the official median price holds steady. Investors and agents tracking these micro-markets are the first to see the cracks widen. When Zillow and Redfin disagree this sharply, it is a warning. The averages are hiding distress that is already spreading through the foundation of South Florida real estate. Opening the annual insurance renewal has become a moment of dread for South Florida homeowners. The numbers on those bills no longer resemble anything from just a few years ago. In Miami Beach, A typical waterfront house now faces a premium of $24,000, sometimes as high as $40,000 just for basic coverage. Condos are not spared. High-rise associations report annual policy hikes of 10 to 30%, with some budgets showing insurance costs jumping from $800,000 to well over $1.2 million in a single year. For individual owners, that translates to monthly dues climbing by hundreds of dollars, even before factoring in special assessments. Deductibles have ballooned as well. It is now common to see $50,000 windstorm deductibles written into condo master policies, and single-family homes routinely carry $20,000 or more. These are not theoretical numbers. They are printed in black and white on renewal notices, and for many owners, they have turned insurance from a safety net into a barely affordable tax. The new reality is that a single hurricane claim could leave a homeowner responsible for tens of thousands of dollars out of pocket before insurance pays a cent. This surge in premiums acts like a stealth interest rate hike. Even buyers with no mortgage, cash investors, retirees, or foreign owners now find that annual costs rival what a 2 to 3% jump in mortgage rates would have meant. For a $1 million home, an $18,000 premium increase wipes out nearly $150,000 in purchase power. The math is brutal. A family who could once afford a $1.2 million home now finds themselves capped at $1 million, simply because of insurance. For condos, the effect is multiplied by association-wide policies and the threat of sudden, unpredictable hikes. Behind every renewal notice, there is a quiet reckoning. Owners who once budgeted for property taxes and maintenance are now forced to recalculate everything, sometimes overnight. The sticker shock is not just a nuisance, it is a force that is pricing out even the well-off and distorting the market from the top down. What was once a manageable expense is now a barrier that reshapes who can buy, who can hold on, and who is forced to sell. Private insurance carriers have been quietly withdrawing from South Florida's riskiest neighborhoods. Internal memos filed with the Florida Office of Insurance Regulation show a steady stream of exit notifications since late 2022, with names like Farmers, AAA, and TypeTap, all reducing new business or pulling out of coastal zip codes entirely. The void left behind has been filled almost entirely by Citizens Property Insurance Corporation, the state-run insurer of last resort. By the summer of 2024, Citizens had more than doubled its policy count, covering over 1.4 million properties statewide, and more than half of all active policies in some Miami Beach and Palm Beach zip codes. The reason for this retreat is found in reinsurance markets. The cost for carriers to buy protection against catastrophic hurricane losses surged 35 to 50% in 2023 alone. For every dollar of premium collected, Florida carriers now spend up to 60 cents on reinsurance, compared to less than 30 cents nationally. After Hurricane Ian and a string of smaller storms, global reinsurers demanded stricter terms and higher prices, especially for older towers and low-lying neighborhoods. This pricing pressure forced dozens of carriers to cap new policies, choose not to renew existing policies, or exit entirely, often with just 60 days' notice to homeowners. The lending environment has tightened in parallel. Banks and mortgage lenders, wary of insurability risk, now require detailed questionnaires for any condo loan, probing reserves, structural reports, and current insurance status. In hundreds of older buildings, especially those with pending repairs or special assessments, loans are approved only with at least 20% down. In some cases, financing is denied outright, forcing buyers to pay cash or walk away. Lenders flag these towers as non-warrantable, meaning Fannie Mae and Freddie Mac will not buy the loan. As a result, liquidity dries up, and the pool of qualified buyers shrinks dramatically. For owners, this new reality means that even if they can afford the insurance, they may not be able to sell unless the next buyer can clear the same hurdles. The system is locking up. As institutional players retreat, financing freezes, and more buildings slide into cash-only territory, the impact is most severe in the very segments already under pressure from soaring costs, older condos, waterfront towers, and investor-heavy buildings. The market's foundation is no longer supported by capital and credit, but by a shrinking circle of buyers willing and able to take on the risk. The Surfside collapse in 2021 changed everything for South Florida's condo owners. But the true cost of compliance is only now becoming clear. Under the new milestone inspection laws, mandated by House Bill 4D and its successors, every high-rise built before 2000 must undergo rigorous structural reviews and fully fund reserves for repairs. For many buildings, the numbers are staggering. At Crestview Towers in North Miami Beach, the board faced a choice. You're right. Either levy a special assessment of $80 million or risk closure by city order. The July 2024 owners' meeting was tense. Board member Janet Lee read aloud the engineer's warning. Without immediate upgrades, the building's occupancy certificate would be pulled. 5 owners argued to delay, but the urgency was inescapable. After heated debate, 62% of voting owners approved the assessment. Several absentee owners did not vote at all. Their units already listed for sale or in arrears. The math for individual owners is unforgiving. Depending on unit size, the special assessment ranged from $50,000 to over $300,000, payable over the next 5 years. Monthly maintenance fees jumped by as much as $1,100. For retirees and families on fixed incomes, the new bills arrived like an eviction notice. Some scrambled for loans, but banks now require proof of compliance with the new inspection laws before lending, meaning no mortgage unless the building's reserves are fully funded and repairs are underway. Others, especially foreign or absentee owners who bought units with cash during the last boom, simply walked away. Within weeks, Crestview's listing count doubled as owners unable or unwilling to pay rushed to sell before the next payment deadline. This is not an isolated case. Across Miami-Dade and Broward, hundreds of buildings are posting similar assessments: $20 million, $50 million, even $200 million for the largest towers. The burden falls directly on owners with no bailout in sight. As these assessments hit, demand for older condos is evaporating. Buyers balk at the risk of sudden 5- or 6-figure levies. Sellers who wait too long find themselves trapped, unable to offload units as inventory surges and prices start to slip. For many, the milestone law has turned condo ownership from a stable investment into a high-stakes gamble. Relocation brokers in Miami are fielding a new type of call: residents looking for a way out. In the past year, Miami-Dade has lost 8,500 more people to other parts of the U.S. than it gained, a reversal from the pandemic influx. The families leaving are not just retirees or seasonal owners. They include recent arrivals who came for tax breaks and sunshine, only to find that the math of living here no longer works. One broker describes a steady stream of high-earning clients, tech workers, finance professionals, even physicians, who list their units after a single year, citing insurance and assessment costs as the breaking point. For those trying to stay, the numbers are relentless. The median cost to own a home in Miami now eats up more than 80% of the typical household's income. That figure includes mortgage payments, taxes, insurance, and association dues, costs that have surged far faster than wages. In practical terms, a household earning $80,000 faces ownership expenses that can easily top $65,000 a year. Even renting offers little relief. With 2-bedroom apartments averaging nearly $2,800 a month, a 15% jump from pre-pandemic levels. Investors who once snapped up condos for Airbnb or long-term rentals are quietly heading for the exits. In Brickell, One managing partner of a local LLC admits to listing 14 of his 22 units at once, an effort to reduce exposure after occupancy rates fell and monthly association fees doubled. He is not alone. Local listing records show a surge in multi-unit sales by LLCs and small funds, especially in towers built before 2000. These owners are not waiting for a rebound. They are liquidating before costs climb even higher or new assessments hit. The result is a market where absorption is thinning fast. Fewer buyers qualify under today's affordability pressures, and investors, once the reliable backstop, are now adding to the supply. Each new listing is both a symptom and a signal. Demand is shrinking, and the path ahead points to rising inventory and downward price pressure. Correction. Windows are already opening across South Florida's most vulnerable segments. Analysts tracking the 2025 to 2026 calendar period point to two main trigger periods: the spring insurance renewal season and the fall special assessment cycle. In Miami Beach and Sunny Isles, the largest price movements have followed these financial deadlines, with sellers forced to adjust listings after premium notices or new repair levies arrive. The forecast for older condos is especially stark. Industry consensus expects a 10 to 15% correction in towers built before 2000 by next summer, concentrated in buildings facing the highest assessments and insurance hikes. Luxury units above $2 million are seeing the steepest discounts, with some recent sales closing at 12% below original list price after sitting unsold for months. The downside risk is not evenly spread. Properties in flood zones or with looming reserve deadlines face the greatest pressure. Each trigger date acts as a checkpoint where owners must decide whether to absorb new costs or cut losses. This is not a sudden collapse. It is a rolling sequence of stress points that compound market weakness as the year unfolds. Buyers in South Florida face a different rulebook now. Before making an offer on a condo, demand a copy of the latest reserve study and the milestone inspection report. If the building was built before 2000, verify that reserves are fully funded and that all special assessments are disclosed in writing. Always get a written insurance quote. Insurance premiums can double overnight. For mortgage buyers, remember that many lenders now require at least 20% down in older or under-reserved buildings. Some towers are cash only. Sellers should consider listing before the next insurance renewal or special assessment notice goes out. Timing matters. Units move faster before major cost hikes are announced. Prepare all required documentation up front, including reserve disclosures, inspection reports, and proof of completed assessments, to avoid last-minute deal failures. Renters should monitor building notices for investor sell-offs or homeowners association meetings about financial instability. Sudden changes in ownership or fees can disrupt leases or trigger rent increases. For everyone, review budgets with room for unexpected hikes. South Florida's cost curve is steep and rarely flattens. Today, the real risk isn't just falling prices. It is that rising insurance costs and relentless condo assessments have redefined what home ownership means in South Florida. As more owners reach their breaking point, the dominoes keep falling. The crash isn't a forecast. It is already reshaping lives and neighborhoods. In this new reality, survival depends on seeing past the headlines. Let me know your thoughts below.